Louis, I guess the big question that everyone's wondering and asking at the moment is, has the Sydney property market bottomed out?
Good question. I think we're in the process of bottoming out. No question, we're seeing more buyers in the market compared to the time prior to the election. So there's more confidence in the market, and that's as a result of three main factors, Peter. Firstly, the election win, which I think has actually improved sentiment out there. The reality was the market was facing potentially a change with negative gearing and increase in capital gains tax. That was definitely a turn-off for a lot of would-be buyers and sellers for that matter. So the fact that we're no longer seeing those changes would have improved sentiment. Second, the Australian Prudential Regulation Authority a couple of weeks ago made an announcement that basically they wish to loosen lending by lifting the servicing buffer of 7%. And that would have meant that the borrowing power for many would-be borrowers automatically increased. And then, of course, the interest rate cut that we had has certainly increased sentiment and once again increased the borrowing power of buyers.
And it would seem we've got more rate cuts coming, Louis?
I think the powers that be are keen to try and stimulate activity, and they want to do that because they're facing a slower economy. So their view is that if we can increase, for example, housing activity in the form of housing construction, overall turnover, that would be a positive for the economy.
So, Louis, is the city facing oversupply of dwellings?
There's a lot of old listings on the market right now, Peter. We've got in excess of about 35,000 properties. At its low point when the housing market was at its strongest, that number was down to about under 20,000. But a lot of that stock is, as mentioned, old stock. There hasn't been a lot of new stock enter into the market this year. So it's a lot of stale properties where either the asking price is too high or there's something wrong with the property. Not that every property on the market right now is like that, but a lot of it is.
And when you say old stock, that's old stock in terms of it's been sitting on the market.
Yeah.
But a lot of that old stock is brand new apartments, right? How is the brand new apartment sector performing?
Well, up until the election, it was not performing at all. There was barely any new apartments being turned over or being purchased.
Completely dead market.
It was a completely dead market. And that was because that market in particular in Sydney was in oversupply, and it was coming up through our rental vacancy rate. So for example, Sydney's northwest, we've been recording rental vacancy rates up to 6%, and in some localities they're up to 7%. And that's predominantly because of too many apartments and house and land estates in that area, creating an oversupply situation, which did trickle through to other regions around Sydney.
Now, at the end of 2018, Louis, you predicted a 6 to 9% drop in the Sydney property market.
Yes.
With most of that happening in the first half of 2019.
Yes.
Correct me if I'm wrong. I think you assumed there was a Labor victory in there with
yes.
negative gearing being removed.
Yeah.
As a real estate agent, what it's felt like to us is the longer the year has gone on, the better it's become. It was a very soft opening to 2019. What are the numbers telling you about 2019 year to date?
Well, year to date, when we actually look at the various indexes, those indexes are suggesting there's been about a 4% decline so far this year. But I think what we're about to see is a bottoming out at that number. And I now believe, and we did come out with this very recently, that the Sydney housing market's likely to record a flat result net for 2019.
So you've updated your forecast for 2019?
Yes, we have. So our view is, okay, first half of the year, the market has and was in correction mode. But the second half of the year, we're likely to see a bottoming out. And I believe the official numbers will show a rise in prices sometime in the third to fourth quarter of this year.
So when you say that it'll be flat for the year, we've dropped 4% already. You're saying we'll make that 4% up and it'll pull up.
We should make that 4% up in our view. Or we'll be very close to it. So net result probably be flat, maybe down 1% net. But the truth will be you've got to see through those numbers and see that, yes, most of the declines have happened in the first half of the year. And second half of the year will likely be a bottoming out and then a rise.
In assessing how the market's performing, is it as simple as saying pre-election, post-election? Was the change in market sentiment that pronounced, if you like?
I believe so. I mean, there's been a number of other events, as we've just covered before, which have also helped change sentiment. But I think there was so much riding on an election in the property market. Potentially, we could be sitting here now and talking about how the market's going to respond to the negative gearing change come January 1, 2020.
So stock levels, Louis, around Easter, stock levels really tightened up.
Yep.
People thought that was the state election, Easter school holidays.
Yes.
The stock didn't come back. It's as tight as it was during the boom.
Yes.
What are the numbers telling us about new listings into the market?
They're telling us there's not too many new listings at all at this point in time. Now, our view is that we are expecting a rise in listings. Let's just keep in mind that we've had in Sydney a 2-year housing downturn. There's a lot of would-be sellers out there waiting for the market to pick up in some fashion, for them to basically sell and either downgrade or upgrade. And I think we're going to see a number of those sellers come through into the marketplace, especially when we get to the spring selling season.
Yeah, so do you think the fundamentals are such that the market can absorb a surge in stock, or are you likely to see a levelling off in spring when we do see this stock come on?
Well, as mentioned, keep in mind there's still a lot of old stock, and that old stock still needs to be absorbed before we're going to see any major rise in dwelling prices. And yes, I do think with the number of buyers out there that I've seen, that it's likely that that new stock will, if priced right, will turn over fairly quickly.
Yeah, as a vendor, it's certainly easier to get a sale now than it was 6-9 months ago, that's for sure.
But vendors still need to be wary that we're not in a boom. This is not a boom. Yes, there are more buyers, but the buyers are still being somewhat cautious in terms of pricing.
And it's not a free-for-all at the banks. That's the other important point, isn't it? Whilst the banks have loosened to some degree, they're by no means returning to previous practices.
That is correct. So many banks now, they are very focused on expenses, a borrower's expenses, doing a lot of reconciliation. They're taking a fairly conservative view. So in terms of borrowing power, while I do believe it has been increasing in recent months, we're nowhere near back to those levels we had, say, from prior to 2015.
So we see this in the media a lot, HEM. That's, correct me if I'm wrong, that's household expenditure measure.
Yes.
And that is what the banks are examining when assessing a home loan.
Yes.
And they're as vigilant around that point as they've ever been.
Yes, that's right. So many banks now, if you speak to the lenders within those banks, they talk about the fact they're now operating on a conservative HEM compared to some years ago. And so that means that they're fairly conservative in terms of a borrower's expenses, so their assumptions for a borrower's monthly expenses.
Just changing tack, Louis, during the boom, we saw apartments in percentage terms keep pace with houses.
Yes.
Now that the downturn has hit and apartments seem to cop it a little bit more than houses, in this recovery phase, how do you see apartments performing against housing?
Well, our view is that established apartments have outperformed in this downturn. And one of the reasons why is because of affordability.
So let's define established for viewers, please, Louis.
It's not newly built, and a unit that's been around for some time.
So is there an insinuation there they don't have the gym, lift, pool, concierge, high strata levies, it's not a high rise?
Fairly standard apartments on low maintenance. I've generally found that they've outperformed the market in this downturn. And they're generally apartments we're talking about which are certainly under $1 million for most of them. And that to me suggests that in part this has been an affordability issue where affordable dwellings have done okay in this downturn, but dwellings which potentially are above the median price in Sydney, they've definitely struggled. And particularly the price bracket of 1.5 through to $6 million, I think that part of the market's been hit the hardest in this downturn. The flip side to that, it's likely that that bracket may well bounce in any recovery.
The rental market, what are we seeing in the rental market at the moment? There seems to be a lot of vacancy. There's a lot of talk in the press about landlords having to adjust prices. That's what the numbers showing us?
Well, we have the Sydney rental market on a vacancy rate of 3.4%. Now, Peter, that's one of the highest results we've ever recorded on our index. We run our index back to 2005, and we do believe rental vacancy rates will likely rise this year further. I wouldn't be surprised we hit 4% in Sydney before it finally peaks.
Does a 4% vacancy rate translate into what a landlord might have to drop their rent in order to find a tenant?
Yes, and I think we're already seeing that. So on our numbers, rents for houses in Sydney over the last 12 months have fallen by about 5%. For units, they haven't fallen by that amount. It's more like along the lines of about 3%. So it is already a tenant's market in our view.
Yeah, I always explain to my clients that if they own a house and they go to sell it, they're not competing with apartments necessarily for a home buyer.
Yes.
But the moment they put that house on the rental market, they are competing with apartments for a tenant. And I think that's showing up in your numbers there, isn't it?
Yes, that is true.
Yeah.
Particularly Sydney's northwest. So as mentioned, we've been recording rental vacancy rates around 6% or just under 6% for Sydney's Hills District. Some areas we've been recording 7%. Now, one may well say, well, that's just a hills area. But the thing is, adding a lot of supply, is what the northwest has experienced in Sydney, can have a spillover effect to other regions. Because if you see quite a fall in rents in that region, that will basically make the other regions surrounding it less competitive in terms of the rent. So we have seen a flow-on effect because of that spillover in Sydney's northwest.
So that's the ripple effect.
It's
in
a
reverse.
negative ripple effect, effectively, yes.
Indeed. Finally, Louis, what's performed best year to date in Sydney?
Year to date in Sydney has been established apartments in our view. So as mentioned, all dwellings, we're recording a fall of about 4% so far. And I would say established dwellings have probably only fallen by about 2 to 3%.
And the top end, that was holding nicely through 2018 as the rest of the Sydney experienced a pretty nasty correction. How's the top end performed so far in 2019?
So stock that's valued over $6 million has effectively flatlined so far this year. So not a bad result given the fact that the rest of the market has fallen.
Louis, excellent information today and thanks for joining us.
Thank you.